Hey everybody, how's it going? Thanks for joining me this evening. Got a great stream for you. Very interesting topic and someone I think you guys are really going to enjoy here. But before we get started, just as people are filtering in, wanted to let people know that I have a new piece over at the Substack today. Went ahead and wrote about Columbus Day. We kind of had the constant battle about Columbus Day and colonization and Indigenous Peoples Day and all of this back and forth, this dance we do every year. And so I wrote something about kind of the reality of colonization and everything. So if you want to check that out, you can, of course, follow the links down in the description below to the Substack and check out that piece. But my guest this evening is Tho Bishop. He is an editor over at the Mises Institute. Thanks for joining me, sir.
Glad to join you. Appreciate it.
Absolutely. So, for people who are unfamiliar, I think a lot of people who watch this channel are kind of already going to know, but can you explain a little bit about yourself and then what the Mises Institute is?
So a little bit of my background is that prior to working for the Institute, I was actually a House staffer for the Financial Services Committee. And on there, I was working for the full committee, but Ron Paul was a member, and so I got to be kind of a mole after the Tea Party wave, trying to get sort of Austrian economics insights into committee business to the extent I could. Spent about 3 years up there, and I've been working with the Mises Institute ever since 2015. And the Institute itself, it's a very interesting place, particularly, I think, kind of right now in this kind of interesting political moment, because, you know, for many people, the Institute is sort of kind of the institutional embodiment of like libertarian theory, right? You know, Murray Rothbard and Hans Hermann Hoppe, and some of the big libertarian intellectuals that are particularly popular online are all affiliated very closely with the Mises Institute. Ron Paul was a founding member. And yet at the same time, we've always been distinct from sort of broader libertarian Inc., right? We were formed kind of in explicit hostility to the Koch world, to Cato, to the Beltway, or as Lou Rockwell would call them, the regime libertarians that are so often kind of referred to when people are bashing libertarianism. And back in the 90s, Murray Rothbard worked very closely with people like Sam Francis and Paul Gottfried during sort of the paleo years, supporting Pat Buchanan. And so when you have so much of the sort of 90s political philosophy kind of resurging on the right, when you have Trumpism kind of bringing back Buchananism, it's this very interesting dynamic where I think a lot of the ideas that are unique to the Mises Institute are more relevant now than ever before, but they are relevant really to the right? The libertarians are doing everything they can to fight this sort of populist, right-wing struggle where so much of the Mises Institute's intellectual heritage, I think, is very much engrounded into that material. And so one of the things that I have personally been interested in as someone who is, in his 30s, someone who's been very interested in this current populist moment, is to really try to identify, I think, specific contributions that Austrian economics in particular can provide to better understanding some of the issues going on. And I think one particular issue is the Federal Reserve, and so the particular role that the central bank plays within not just the American, the global American regime, but really, modern states as a whole. Because I think if you appreciate what central banking really does, it opens up a lot of doors into understanding the patronage of the managerial class. It goes a long way to understanding modern warfare. It goes, I think, fueling a lot of the sort of elite theory dynamics that the right is really interested in right now. And I know economics can get a bad term out there. I understand why. Again, most free market thinkers are, are the worst sorts of defenders of these ideas. But I'm here to kind of try to make an argument that there's still some value, particularly with the way the Austrians view economics as a science and the institutions they're about, that can actually provide some value out there to the new right or dissident right or whatever you want to call it.
Yeah, I always have to, every once in a while, I'm not always kind to libertarians, but I always have to be to clarify when people jump in, like, well, I'm not talking about the Mises and the Hoppians. I'm not talking about you guys. I'm talking about the Lolberts. I'm talking about Reason Magazine. I think that is important that there's truth in, or there's a lot of value in kind of that Austrian school of economics and its analysis, but that doesn't always lead us to the conclusions that like you said, the beltway libertarians then bring to the table. And so there's a disconnect maybe between analysis and application, but we'll get into that for sure. So I want to let everybody know, because I know there's going to be a lot of people who are already very familiar with this, who know way more about it than me for sure. I just want to be very clear for everybody. This is going to be a learning experience. Tho is here to kind of take us to the very basic level and walk us through like just basic guide of what is the Fed, how does this affect monetary policy, what do we need to know about it, and then near the end we might get into more of the more complicated application. But if in the first little segment here, if this sounds really basic to you and obvious, just understand that that's why we're here. We're setting out a basic building block so everyone can get up to speed and then move forward with kind of this application. So before we get started, we threw around the term Austrian economics a lot there. For people who are just completely uninitiated, I know it's a huge subject, but how would you, what's the 2-minute elevator pitch for Austrian economics? What is it? Why should we care?
Yeah, so the reason it has that term is that Ludwig von Mises, Karl Menger, some of the big wigs, they all originated in the University of Vienna, the good old Habsburg days, right? For the most part, Mises and his student Hayek had to flee Europe during World War II. And so for the most part, the Austrian school has been located in America ever since, but that's how it gets the term. So really what separates it is that it's again, most of economics today is often sort of propaganda for a certain ideological cause, right? And you kind of see it with the way, if you read an economics paper, it's very math oriented, it's about modeling. And, it's very positivist in its nature. This kind of stems from the kind of Keynesian revolution of the 1930s, which was a big breakaway from what was called like kind of neoclassical economics prior to that. The Austrians were unique. The origins kind of came from value theory and kind of subjective value and marginal value, which are all kind of very fundamental terms in economics, right? But the idea that if we understand the value of goods, it comes from the marginal utility of it, not the good in itself, refuting the labor theory and sort of the Marxist sort of ideas there. So what Austrian economics really is, it's more about a methodology than it is an overlying ideology, even though most Austrians tend to be libertarian and free market. So the idea is that the proper way of doing economics as a science, it's not kind of looking through history and trying to draw conclusions because there's no control variables, right? We can't recreate the sort of scientific method when it comes to social sciences because there's all these variables. So the methodology of the Austrian school is something called praxeology, which is a complex word, but basically it focuses on understanding that basically there's a fundamental logic of trade-offs, right? Where we're individuals, we're dealing with subjective values, where we're dealing in a world of finite resources. So when we decide to do anything, whether it's how we spend our time, how we spend our money, deciding to make a car out of metal rather than building a whole bunch of paper clips, right? All of these, we're making those decisions based off opportunity costs, and that there's a logical foundation to understanding that there are finite ways to use resources, and the way that we decide the optimal way of using goods is by quantifying them through the price structure. And so this is why Austrians are very pro-market, is because the price structure creates a way of mathematically comparing the way we factor, the way we make decisions on kind of bulk goods through, to making sure that we're using good uses for it. And so a key element that Austrians understand is the concept of time, right? There's a structure of production. If we're setting aside resources for something that we're not going to benefit from for 5 years, that is different than consuming that good right now. And so this idea of time preference, that this price of money, is actually very important to the conversation about the Fed, because one of the most important prices that we have in a society, more important than the price of wheat, more important than the price of fertilizer or metal, is the price of money itself. That's the interest rate. It is what's the price that society places on a loan. And one of the big Austrian critiques of the modern economy is that when those interest rates are no longer made by the market, they're no longer decided by the decisions of rational actors in deciding to invest or not invest, and then the interest rate becomes simply a policy tool set by arbitrary government whims. And when you do that, you completely undermine society's own demonstration of their own preference, right? If you have very high time preference, you want to consume right now. If you have low time preference, you save more. You want to save, you want to consume in the future. And so all of these dynamics are very unique to sort of the praxeological perspective of economics as a science. And so we don't see really a distinction between macro and micro in terms of methodology, the same way that most mainstream views do. And so what makes us different, it's not simply the way we view the economy as a whole, but foundationally how we teach economics. And that's why it can be very kind of difficult. It doesn't fit, these sort of neat ideological battles there, because it's about a methodology. And if you come from a mainstream background like this, all this sounds like complete hokum, and I understand that. But that's kind of really what makes the Austrian school very distinct. It was what makes it very different than Milton Friedman, the Chicago school, a lot of other free market or libertarian schools out there. It's something very distinct to us, and it goes a long way kind of informing these larger views about institutions like the central bank.
And for those that are familiar with more neo-reactionary NRX theory, they'll recognize time preference, its application when it comes to Hop and then Nick Land, when it comes to democracy and governments and that kind of thing as well. So you might be familiar with that terminology from another direction if you're familiar with that at all. So there's obviously quite a bit of overlap between the kind of the Mises Hoppian wing of libertarianism and NRX. A lot of people who kind of founded NRX are kind of disaffected libertarians and tended to come out of that tradition. So a lot of people will see the overlap there and the influence of that thinking. But before we get way deep into our theory rabbit hole, let's go to our very basics. So Tho, what is the Federal Reserve and what does it do?
Yes. So the Federal Reserve is America's central bank. I know a lot of people fixate on, it's a private bank. I think it's kind of, it's an extension of the regime. It's an extension of the government. It's made up of a board of governors, all of which are appointed by the president and, approved by the Senate. It is a relatively modern creation, 1913, one of the peak progressive era platforms. There's a longer history of central banks coming and going within American history. This was a very Hamiltonian idea, a very Clay idea. And between the second bank in the United States, we had a lot of banking laws that the Lincoln Republicans put in that didn't work very well, that kind of contributed to the case for a Federal Reserve later on. And so, and it's also, I think, most importantly, the Federal Reserve, ever since 1940s and Bretton Woods, it's the central bank for the globe, essentially, right? Most central banks pair their currency to the dollar, which means that we basically have an influence on most monetary policies that central banks do. It's also a very important source of funding for the economics profession. It's the number one provider of grants within the economics profession out there. And so you have this other dynamic of the Federal Reserve as an institution, is that not only does it handle the monetary policy of the U.S., not only does that monetary policy affect fiscal policy by helping provide, by buying up U.S. Treasury bonds and creating a bigger market for debt, which allows the legislative side to spend more than otherwise would. But it also has tremendous impact on the ideology of central bankers around the world. Most central bankers kind of are influenced by whatever the state of American economics is. And so all of these are different components of, again, the Fed as a political institution, a Fed as a collaborator with the regime, and a Fed as an intellectual institution that have various different aspects of, the different impacts globally and domestically. And the secondary thing, on which I'm sure most of your audience is aware of, is that since 1971, the Fed has basically had no check on the money creation powers, because that was when you had the very last tie to gold as an independent kind of benchmark for money. And that measure, that change in 1971 is something that is truly revolutionary in the grand history of state power. Because prior to that, usually there was some connection to gold, silver, that served as some sort of measure for previous central banks. The Bank of London was the big powerhouse prior to the Federal Reserve. And so really, if we think about the history of the Fed, we can look at pre-1971, post-1971, and particularly post-2008, 2009, where things really got wonky. These are different eras of the Fed's history that have major, that resonate with very different policies and different impacts therefrom.
Excellent. So it's a good overview, and so like I said, I really want to drill down. I want to take it to the most basic elements, so that as we put this together for people, they're complete. They're not assuming any knowledge. So let's go to the very beginning. When do we see the rise of kind of the current iteration that people would understand of the Federal Reserve, and how does it set monetary policy? Like what are the nuts and bolts functions that allow it to determine interest rates, influence this kind of thing? How does that work?
So again, I think in order to best understand the way it works now, it's useful to kind of look at the way it happened prior to, it kind of originally.
Mm-hmm.
Because that kind of gives you an idea of what makes the current bank different from past central banks. And basically, there was prior to, again, like the 1930s, something called kind of World War One. There was the classical gold standard, and the way that kind of worked is that if you had the Bank of England, you had a measure of gold connected to, the British pound. That if you could take your banknotes and you could exchange them at the bank, and you would get specie hard currency metal in return. And you had an entire banking system that was kind of built off of this. Different banks had different notes. The idea of kind of a universal paper currency, particularly in early America, was not around. You had different banks, and so this created kind of concerns about, you don't know the trustworthiness. If you're in Philadelphia and you do business in New York banks may not know the trustworthiness of your Philadelphia bank, right? And so that kind of led to gradual arguments desiring a central bank to have kind of a monopoly over paper money in exchange, as opposed to money being understood as solid as metal coins, right? Mm-hmm. And so prior to that, money was gold. Paper currency was credit. It was based off the reliability of banks. We get off of the gold standard because of war. There's some very interesting stuff. The Bitcoin Standard is actually a really good book, even if you're not interested in Bitcoin, about some of the history and kind of larger consequences of it. You can tie into sort of the rise of total war with the increased ability of central banks to detach themselves from the restraints that gold placed. They could print more money, it inflated the currency, but allowed for the first receivers of money, which usually governments, and then secondary corporations close to the government or banks, the second receivers of that newly printed money. That fuels war efforts, right? And so the 20th century is, again, not coincidentally, the century of central banking and the century of total war. So basically, we get down to, we banned gold convertibility in the 1930s. That leads to basically gold serves its function mainly as an international standard. So if you were the central bank of Germany or the central bank of France, and you are getting U.S. Treasury debt, you're getting currency, you could go, you as opposed to American citizens, could go to the Fed and interchange your dollar holdings for gold from Fort Knox or something like that, right? Charles de Gaulle actually started to do this because America was printing a ton of money. They were printing a ton of debt. You think of the guns and butter of the LBJ Nixon years. We had a growing welfare state. We had a growing warfare state. So you had states getting worried that America was taking advantage of being this sort of global currency. And so Charles de Gaulle wanted to exchange French-held U.S. debt to the Fed in exchange for gold. That's what led to the pressures that got Nixon to drop this convertibility entirely, which created the fiat standard entirely. And from that point on, there's been no sort of benchmark using gold. We moved from a gold standard to what Jim Grant calls a PhD standard. After that, the main kind of function that the Fed used to set interest rates on the market was using overnight operations with prioritized Wall Street banks. These are called primary dealers. So they were the ones in charge of setting treasury markets, and it used overnight operations to kind of use that as a policy mechanism where the Fed would buy rate, it would set the price for bonds, would set the price for treasuries at a certain level, and Wall Street would they have to set overnight money holdings, so they would exchange that with the Fed. And that was the way that operations were held. If the Fed needed to increase the money supply, they would buy debt from banks in exchange for currency. So their cash holdings went up. The Fed's debt holdings went up, as on the other side of things. And so that's the way that they were kind of maintaining monetary policy. This wasn't enough during 2008. In 2008, we had a massive financial crisis. We had all sorts of debt out there that banks were unreliable. And so the Fed started completely revolutionized the way they handled monetary policy away from their traditional policies to all sorts of new tools. So this included buying up whole new asset classes from these Wall Street banks. So they started holding mortgage-backed securities that were full of toxic assets because of the housing bubble, right? The Federal Reserve today is the largest holder of mortgage-backed securities in the history of the world. It makes up a gigantic portion of the mortgage-backed market. This all helps fuel kind of the modern housing crisis, right? Because if you have the Fed buying up all these mortgages, you're right, it's easier to originate mortgages. This is kind of Fannie Mae and Freddie Mac sort of role back in 2008, where they were, you would have banks originating stuff because they didn't have to hold on their balance sheet. Well, the Fed just kind of became the ultimate housing lender, essentially, by being a lender of last resort for mortgage security debt. The other side of it, which is very interesting, and an aspect that's not talked about nearly enough, is that one of the top tools that the Fed now uses is paying interest on excess reserves. So there's a completely new policy. If you look at like the history of excess reserves held by banks, there's a lot of one thing the Fed actually does really well is they provide a lot of really good charts. Sometimes they'll discontinue certain stats that they don't like, but for the most part, if they haven't done that, the charts are really easy to create and all that. If you look at the history of excess reserves, now the excess reserves would be money held by the banks beyond what the Fed states that they must handle. Historically, up to 2008, it's basically nothing. And then it goes way, way up in 2008. The reason why is that this is actually something that Congress authorized. The Fed sped it up because of 2008, is that the Fed can pay interest on top of reserves that these banks hold beyond their mandated limits. And so what that means is that if the Fed increases the rate, the interest rate to 3%, they will increase the interest that they're paying on excess reserves to kind of match that, right? So you're going to be paying, so the banks are going to be lending out money only if it gets higher than what the Fed is paying them. So so if you want banks to be lending out money no lower than 3%, you raise the excess limit to 3%. Because that's if it they're going to take the sure thing they get from the Fed from anything lower than that. And so this is a complete change in the way the Fed conducted monetary policy up to this point. It also creates this very interesting dynamic where the operations of the Fed have been to pay Wall Street banks not to lend money to Americans. And this is money that would otherwise go back to the Treasury, right? So the money that the Fed makes its own money, the profits of the Fed go back to the Treasury. The Fed pays out to the Treasury, to these banks paying this excess reserve rate from the money it would otherwise go back to the Treasury. And so it's been this very interesting game where, again, basically taxpayer dollars has directly subsidized Wall Street banks by giving out money for zero risk investment since the 2008 crisis. And the more the Fed increases interest rates, the more money that you are paid out for these excess reserves goes up. So this is another way of kind of help. Again, the big desperation, right, 2008 was that, we can't allow another big bank to fail. We created all these ways of flushing the system full of funds. This was one of the ways they did this. And so again, since 2008, there's been this radical change in the way the Fed has done business. And we are continuing to kind of when we look at people acting right, we're in uncharted territory, right? Because this entire system of central banking is still, it's less than 2 decades old, right? This is a baby in the grand scheme of something as serious as monetary policy.
And so I would say, just, looking at that explanation, that there are, of course, many problems with a number of the things you talked about there. But what we're seeing is a disassociation of kind of risk from actual action, right? You can't get the economic signals you're supposed to. You can't get the actual feedback, because in order to give the reserve the power to have greater control and ability to manipulate the economy, you have to separate consequences from kind of the actions that are happening there. You have to remove the risk from bad decisions, and so they're not getting the kind of feedback that would otherwise regulate risky behavior.
Right. When we think about lowering interest rate, I mean, one way to think about it is that we're actively subsidizing risk. You're absolutely correct. And the consequences for this are really terrifying once you sort of moving outwards, right? Is one of the explicit purposes. So a part of the Fed, I should have talked about QE. QE was when they started buying and expanding the Fed's underlying balance sheet. So they're printing money to buy assets from the banks. And again, you could look back and you have the history of it. There's different sort of raises of the balance sheet based on QE1, QE2, QE3.
This is quantitative easing for people.
Yes, quantitative easing. It's printing money, buying assets. That's what it was, and that was the main way that they injected money into the system, because again, the traditional way just wasn't fast enough. The reason for that was explicitly to prop up stocks, right? So, and again, and they were very transparent about this. They were using Fed speak. This is also something worth mentioning. One of the other primary tools the Fed has for conducting policy is, by their own words, communication. So like the way when the Fed releases an announcement, the language is very carefully gone through to try to so that every little word change is meant to signal something further out. The idea is that, particularly during the financial crisis, Bernanke wanted to increase money going through the system, but not concern people that inflation was a thing. And so they would try to kind of create a timeline like, okay, here is how we're going to normalize things. Here is what we are projecting things are going to be 6 months from now, a year from now. They're trying to they've created different charts and graphs, all to try to project the appearance that they know what they're doing while engaging new ideas. Because if you lose the worst thing that can happen to a monetary system is for it to lose trust. And so the entire idea of this forward guidance was to kind of make it very clear that these very serious economists know what they're doing. The problem is that the Fed has been horrible at nailing any of their predictions by their own admission. You can go back and look at Bernanke when the balance sheet of the Fed was $1 trillion and saying, don't worry, we have a plan of reversing this in like the next 12 months. Obviously, I mean, it's only grown up exponentially since then. And it went up during Bernanke's reign. Like this is something that someone else came in, Jan came in, injected up. Like, no, he's been regularly lying about this repeatedly. Now, also part of this is that, when they were doing this, so the big benefactors of the Obama years in particular were people, if you're subsidizing risk, and at the same time you're lowering interest rates, which means that if you're putting money in a bank account, right? If you're buying, if you're going to invest conservatively, right? You're buying a government bond, right? You're doing something that's relatively risk-free. Your return on that asset is basically nothing, right? So what that did, again, going to this aspect of subsidizing risk, if you were a normal person and you wanted to keep money in a savings account or buy a CD from your bank, right? So it's, you have a sort of set time period that you're loaning that money to your bank, or you're buying a treasury bond like the way a lot of retirees or pension funds or insurance companies prefer to do because they need just kind of conservative, dependable growth, you're getting screwed, right? Yet if you are buying stocks, if you're buying real estate, if you're buying all these financial assets, your valuation went through the roof. And so if we're looking at this complete dynamic of rewarding a certain class of Americans and hurting the working class, right? If you were scared of the stock market, you got screwed during the Obama years. If you're listening to Dave Ramsey, right, and he's telling you that debt is bad, while you can get loans that are artificially cheap and buy stocks that are risky but paying out the wazoo because it's a gigantic bubble, then you were getting screwed. If you were doing the responsible thing, our economic system was playing you like a fool. It's the people that were reckless that were benefiting. In fact, Trump actually has this moment during like 2015, 2016, where he makes this point explicitly. He's like, yeah, hey, look, low interest rates are great for me. I'm a real estate guy, but it hurts the hardworking people. And it's absolutely true. So there's a very big class dynamic going on here. And this is there's something called Cantillon effects within economics. Like this, the first receivers of money. So that's at play as well. because when the banks are getting this money coming in from QE, right, they are trying to get their return for their investment. What you saw was massive increases in certain sectors of the economy. This money was being pumped into big tech. This money was being pumped into pharmaceutical companies. This money was being pumped into New York real estate. The first receivers of the money, the first places that Wall Street decided to park this new money, were typically industries, right, that we now kind of consider the ones that are the most troublesome, right? And that dynamic, and it's a direct consequence of monetary policy. There are some additional dynamics which we can get into, but it's a little bit more complicated with the way that different financial regulation internationally treated debt, that led to large corporate debt basically being used as a money substitute, which kind of further consolidated industry. Because the real consequence to understand here, right, is that what we've done is that the financial system itself, something we can call financialization, right? We financialized the economy, where success and failure on the market becomes increasingly dependent upon your closeness to power and not merit, right? So if you are a small company, you're trying to break out and you want to innovate, or you want to distinguish yourself with customer service, or any of the sort of things that we would think would be rewarded in a meritocratic market. Well, guess what? You have a large company. They can take out a bunch of debt using with access to cheaper loans, and they can buy up your company, or they can acquire your company, and then they'll destroy your company because they don't want the competition, right? The closer you are to Wall Street, the closer you are to the regime, the better, the more the financial system itself protects you, rewards you, subsidizes you. And the further off you are, the more you're screwed, and no one's screwed more than the worker. So these are some of the consequences of this gigantic change in the way that we've conducted things. And again, this should be an outrage, but because it's baked into the boringness of monetary policy, the Fed ever since Alan Greenspan, Federal Reserve chairman, deliberately use very boring, wonkish language to describe their basic operations. There's a great a book called The Lords of Easy Money, where it kind of identify the way that like Ben Bernanke or Alan Greenspan addressed like Congress right in front of C-SPAN cameras, and the way that they would talk about the same exact concepts within Federal Reserve board meetings whose minutes aren't released until like 5, 6, 7 years down the line. And like talking to other economists, he uses language that anyone can understand. Talking in front of C-SPAN, he uses something called Fed speak. They intentionally disguise how radical these policies are using deliberately dull language, again, as one of the many ways the Fed smokescreens this entire operation.
So, as you know, we're going to connect this eventually to managerial, the managerial state, of course, and you've already mentioned that a number of times. But just to stop and connect it real quick, it sounds like the issue, as with almost everything in our kind of a managerial state, is that it allows the ability of the federal government to manipulate the economy, allows them to centralize power and reward their friends. It reduces the power of independent people who aren't completely tied in and enslaved to the system, because their investments can be manipulated, devalued. The people who are playing the game that benefit those in power are the ones who see the greatest rewards. And then over time, naturally, the influence shifts away from those individuals who are outside the system and towards those that are directly kind of in league with lobbying, playing the game of those who get to manipulate the currency.
Absolutely. And this is pretty explicit because the number of banks that have the closest relationship to the Fed are very small in number, right? You know, they're the JP Morgans, right? You know, the Bank of Americas. And again, this was always, like, if you read like Murray Rothbard and his sort of origins of the Fed, which is very interesting, it has a great kind of power-related analysis aspect where he has this great line where like all of 20th century politics can only be understood by understanding the battle between the Rockefellers and the Morgans. And so the entire goal of the Fed and its originally was to kind of cartelize banking power into select privileged Wall Street banks. This has continued on. There's now a few banks that are outside of Wall Street. I think Bank of America, I believe, is based out of North Carolina. But the same dynamic of a very small group of banks that can be depended upon to do what is necessary, right? That is maintained. And the number of banks has vastly reduced itself. There is a secondary component to this, where again, this is where there's another aspect of the Obama years that further consolidated this economic power. But it's a bill called the Dodd-Frank Act, which was thousands and thousands of pages of what you would expect kind of banking regulations would be. The response that was a response to 2008, right? Wall Street banks bad, too big to fail bad. So we've got to come in, we've got to police this stuff. The consequence of the Dodd-Frank Act, because there were so many layers of regulation within it, was destroying community banks, right? We saw massive merger waves of small community banks. Community banks typically being the largest originator of loans in small towns, right? So if we want to go to this dynamic of what has been destroying small town America, well, guess what? If all your small town banks become branches of Wells Fargo or Bank of America, and they are less likely to loan with you because you don't have that traditional relationship that you have with that sort of It's a Wonderful Life small town banker, right? The entire system becomes foundationally about size and political connection, rather than, golly gosh darn, does the banker that's known you for 30 years, are they willing to take a chance on you with a loan that's going to be a little bit higher than someone more established, but willing to give you an opportunity to provide, to open up that little shop in your downtown of, 5,000 people, right? So there's a financial regulatory aspect as well it's not directly connected to monetary policy, but it goes to this larger narrative of the weaponization of money in banking, again, to benefit those closest to the regime and hurting those that have any demonstration of independence. And there's another matter that a little bit of a tangent, but I think might invite questions that some of your audience have right now, is that basically if the Fed is doing all of this, and if the Fed is printing all this money, then why are you Austrians who were predicting hyperinflation back in 2010 and were wrong, right? Why should anyone care about what Ron Paul has to say about the Fed? Because he was making a big deal about this in 2012, and none of this came to be, which is a valid concern. But one of the interesting aspects of understanding the role of the Fed now is if you take a global view, and you then recognize that every other bank in the world has been following more or less this Fed model, but with even greater extremes. That is one of the biggest things that, sorry, my dog's barking. That's one of the biggest things that has benefited the Fed, right? Because global finance it's a game of kind of relativity. We're as a global reserve currency, we are already the biggest. We're the biggest pawn, right? So an increase in us is a lot less than if it's like peeing in the ocean versus peeing in a pool, right? And so, like, the ECB has been even worse. They've had negative interest rates. We've had zero interest rates. The Bank of Japan, we buy mortgages. They buy stocks, right? And think about you want to talk about the axis of control there. You have the stock. You have the central bank actively choosing what corporation stock to hold on its balance sheet, right? Even the Bank of Switzerland, which is kind of historically right, they've been doing negative interest rates. China's been doing stuff even crazier. So this is a global phenomenon as well. This is something unique to the Fed, and that's important for understanding why the Fed can get away with it. The only bank that really has not been engaging in this sort of ludicrousness of modern central banking has been Russia, which has maintained a very, very low debt, has bought a whole bunch of gold. So their gold to debt ratio has gone down significantly since 2008. I'm not here to overly praise the way that Russia does government generally, but that is interesting that the one kind of standout from this global change in central banking has been Russia, rather than the rest of the world that has doubled, tripled down on the same policies the Federal Reserve has been doing.
Yeah, you would kind of have to in order to avoid being, being a slave to kind of what's going on with the rest of the system, right? But before I want to get to move towards solutions. So now that we have a better understanding of what the Fed does, I want to get into a little more now of your thoughts and the Mises Institute on how to fix this. But before we do, we've talked a lot about the gold standard, precious metal standards. I want to take just a minute to kind of parse that a little bit, because I'm guessing that precious metal standards are going to be part of your solution, but you can tell me in a second. But one thing I want to talk about is I don't think 71 is the first time that America flirted with going off the gold standard, right? We had we had a lot of farmers being sold the idea that silver was the key to inflating their way out of debt in the 1870s, 1880s. And then we had, the Cross of Gold speech, and it was told that the bankers were the ones that wanted to hold on to the gold standard because they were greedy and they wanted to lock these poor people into their debt, and it was to the benefit of the poor to inflate their way out of this. So if we could talk a little bit about that, and also just not to pack too much into one question, but I just want to make the point that also, like, obviously precious metal standards don't completely stop the problem of banks just inflating their way out of this stuff, right? Like Diocletian managed to tank the value of the Roman currency back when it was gold by just putting less in,
Right.
the currency, right? So this, I understand it's a problem of scale, right? But it doesn't completely solve the problem.
Well, ultimately, it's a matter of trust. And we'll go to those issues, right? And that's why well, at least my personal solution, it's not necessarily gold itself. I think gold has some shortcuts, which I'll get into. Going to your point, though, you're correct that, and again, and this wasn't even necessarily unique to kind of the William Jennings Bryant days. Historically, this was kind of a common pattern that this was a consequence of paper money within pre-modern societies. Is that okay? You've got a bank, you've got a bunch of gold, you give out money in return, and then you kind of realize, hey, we've got a number of liabilities from people that need that expect the ability to get gold back, but we know we're not going to make all these claims, right? So we don't need to necessarily have all of this gold in our vaults because it's going to sit there unused, right? So, I've got a great idea. We are going to loan out this gold that isn't ours, make a profit, and we'll have it back in our vaults to make sure that by the time that, Farmer John down the road needs his gold, then we'll have no problem paying it back. And then really, we don't even need to ever have 100% of our gold in our vaults. We can constantly be making loans because as long as not everyone comes to claim their gold, then we'll always have enough to make do with the transactions we need to make, right? And so it's something called fractional reserve banking. And so if you were to read, and this is a subject it's really fascinating. It's really nerdy really quickly. But like within Austrian economic circles, there's long been this sort of dynamic about the full reserve banking, which you can kind of think about it like Harry Potter banking, right? You've got your vault like Gringotts, and it's protected by dragons, right? And you go there, and there's just a whole bunch of gold coins, and the gold coins never leave, right? And it's like that is Rothbardian banking to a T. J.K. Rowling was an advocate of Murray Rothbard's view of gold, silver, and banking, right? Very interesting.
I don't want to have to hit you with read another book. I know,
I know, but it's the one example I can make. But like,
I gotcha.
So, but yes, that's the one thing there. Everything else, the way that most banks function, though, is that you have this paper dynamic, right? Mm-hmm. And so the problem is, though, is that you have banks is that when you have a loss of confidence in the banks, right? You have people that make that bank run. The common example is It's a Wonderful Life movie. Some the nerds out there would argue
the money's in your house. The money's in your house. Yeah.
Right. Yeah. And so people argue like that's actually not a bank. But neither here nor there. It works enough for this example, right? So you have bank runs, and so if you think about the historic lessons of the photographs from the Great Depression, right? Those all came from bank runs, from banks overextending itself, and the role of the Fed was to kind of come in and kind of help prop up banks, and they would end repayment in specie, that hard currency. You'd have a bank holiday. And Bank of England had to do this after, during the Napoleonic Wars, right? They had to spend so much money fighting Napoleon that, they had to end convertibility. The result of that is inflation, right? During World War I, you had a massive inflation fighting that war. The mistake that, that the Churchill government made, right, was trying to connect the pound to the pre-war gold weight, rather than take into account, right, all the money that was created, right? If you have 100 pounds and 100 ounces of gold, but you now have 300 pounds, right? Then you should just connect it. You should divide the value by a third, and then it's repegged. But they didn't do that. They try to reset back. That creates its own sort of deflationary, like you have to destroy money, which is painful, right? And so you have this constant issue of overinflating the paper currency, and during times of various economic crises. and that kind of creating an issue there. The Austrian response to that, and again, I'm not trying to say gold is the only way out of this stuff. Would be focusing on the full reserve side, right? If it kind of takes away the need to trust businesses with the business practices of these banks. Now that can restrain your ability for capital markets, right? It does reduce the amount of liquidity. And so ultimately, if you're going to have a functioning gold standard, you need institutions that you can trust to be reasonable with funds, right? You need to be able to trust that your central bank is not going to abuse its privilege. Is that something that can reasonably be trusted? I mean, history does show that there are periods of really good bank policies, right? But for the most part, you have, again, even back before you had paper money, right? You had Romans clipping coins, right? This is what the issue with gold, of course, the reason why it lends itself to consolidation is precisely the fact that, all the understandable issues of it's heavy, right? You have security issues. If you can't afford to protect, if do you want to really have, $1 million in gold coins, in your own house? That kind of opens yourself up to various bad guys wanting to come and take it from you, right? And so a gold standard has trended towards centralization. And that tends to end up being centralized within the state itself and state banks. This is where Bitcoin kind of came about. Mm-hmm. Bitcoin was directly inspired by the work of F.A. Hayek, his work on the denationalization of money. A lot of the current Bitcoin space has been very influenced by Austrian work in a variety of ways, particularly sort of the cultural consequences of money production. If anyone's interested in that work, Guido Holzmann has a really fascinating work on that. He's a German economist. And so their idea was basically Bitcoin is something that can be exchanged peer-to-peer. It doesn't require a centralizing bank, right? So it is something that can be handled without the needing trusting a third institution. If you know how to secure your keys, you can be very self-reliant upon it. You don't need to trust the Coinbase or a crypto exchange, right? Your key, your coin, your keys, sort of self-reliance aspect. And so Bitcoin was, which was a direct result of the 2008-2009 financial crisis. It was meant to solve the problem of money and banking and the break of trust. That is what is presented as a technological solution to replicate the gold standard, but not have that centralizing aspect of the gold standard. The problem, of course, is that anyone who holds cryptocurrency, and I do, we've seen that it has not performed particularly well during this inflationary environment. The reason why is that it's not the problem of Bitcoin itself. The protocol still works. You even have people in China, in spite of crackdowns within Bitcoin within China by the extent and power of the Chinese government, you still have people doing peer-to-peer exchanges there. So it has kind of upheld its bargain as being a state-resistant private currency. The problem is that the infrastructure around Bitcoin, which fueled a lot of the investments in Bitcoin, has been propped up itself by the easy money policies, the low interest rates of the past, 12 years. Mm-hmm. And so when you have so many institutions that are operating off of leverage, right? Your debt, if you were borrowing debt at 2% 3 years ago, and you're now having to, take out, and those same loans now cost you 8%, 9%. That is a massive increase in the cost of your business, right? This is also why, again, when you get a large corporate landscape addicted to low interest rates, and they're not being profitable, they're relying off of cheap loans. You have a bunch of zombie firms, which Europe has. This is a global problem. I mean, Europe is screwed in this regard, on top of the energy issues and everything else. But when you have crypto firms that are addicted to the low interest rate policies, that creates a lot of selling, that lowers lowers confidence in these products, You have spin-off, shitcoin, right? Alternative coins out there, right? That further dampen enthusiasm and kind of lower the psychological view that people have of Bitcoin as an underlying asset. You have concerns about the safety of a Coinbase or some of these major exchanges, Binance and et cetera. And so the problem is the infrastructure around Bitcoin, which is almost necessary for normies to use it, and you need normies to use it for it to become wide enough, right, to kind of really take that role. The faith in that has gone down in spite of inflation going up, where a lot of Bitcoin people thought inflation was going to be the save the day, right? And so you have institutional problems on both sides. One is you've got a lot of, again, you have a lot of malinvestment. You've got a lot of shady institutions that have sprung up to try to make Bitcoin easier to use because it's trustless. And on the other side is that if you try to use a gold standard, then it doesn't necessarily solve the centralizing aspect, the tendency that gold has played overall. So that's where, I'm not here to pitch you here's the libertarians have one great moment. If we were just being listened to, right, then all of our problems would be solved. No, there's trade-offs here. Yeah. There's absolutely trade-offs. And so kind of the Austrian approach to this is basically what we need is to expand the market for money. We need to allow for greater competition to see what kind of rises up. And that's the best way of kind of checking, I think, some of the consequences that come from monopolizing the power of money. And of course, this desire to monopolize money is precisely what we see the government's response to this period, right? And this is why you have the ECB and the IMF and all of these cartoonishly villainous figures pushing central bank digital currency and a war on cash, which is terrifying, right? The entire goal of the war on cash is that no transaction that you can have can't be tracked, right? And so I think the way that I kind of view this current moment is it's not necessarily gold versus Bitcoin or whatever. Ultimately, I think the defining battle that shapes so much of these things, it's going to come down to what wins out in this sort of this monetary reset that I think we all kind of feel is happening. Is it going to be further centralization of globalist money, kind of the great global victory of the IMF, kind of finally fulfilling John Maynard Keynes' golden dream, which is an IMF currency was called a bankar, which was going to be a global currency controlled by a global central bank and all the power there within? Or is it going to be people losing faith in any of these bastards and instead moving to a private currency, be that being gold, be that being Bitcoin, maybe a corporate bond currency, which is some crazy idea that Rand Paul had. I am a little skeptical of it, but whatever. Local script, whatever the other solution is, political versus private, globalist versus kind of populist within the monetary sphere. Again, there's no obvious golden silver bullet here.
Okay, yeah, I really appreciate you pointing out there's not an easy solution here, because I think that's really important. I'm not going to pretend to be some kind of monetary policy expert. This is not my area of strength. So I'm going to be mainly looking at this through the lens of kind of power and centralization and managerialism. And all of the problems that you express there are the same problems that get iterated over pretty much every attempt to address this centralized Leviathan, be it politically, militarily, financially. It always seems to be the same problem. So we understand, and for maybe people who are listening, let me take a second to stop and kind of apply this. For people who are following, basically the reason that the Fed is so important to Leviathan and its growth is that it allows them to kind of have more or less infinite money to start wars and reward friends and incentivize behavior that would otherwise be far too risky, that is directly rewarded because it happens to be close to power and be able to lobby the regime for its rewards. It also allows them to disincentivize the things that like localities and small businesses and communities would be good at, and take away their influence and their power and make everyone beholden to kind of the policy monetarily and to the different things that it incentivizes through monetary policy, which includes large corporations, risky investments, vast spending on things like military adventurism. So these are all things that the current Fed policy allows. And as you pointed out, our solutions have themselves limitations and problems, because if you go to the gold standard, while that might, or some other precious metal standard, it might reduce the ability of like wacky clown car investing that the Fed gets to do, but it's still an issue of trust and centralization. And if you go to Bitcoin, the problem that I've always, that people have always brought up with Bitcoin that I've never heard anyone answer is like, what happens when the state decides to shoot you, right? Like the Bitcoin solution seems to not acknowledge the fact that the state still has the ability to like stop you from spending Bitcoin. But maybe you can spend a little more on that.
That's one of the things that sold me on Bitcoin, to be honest, because I was a traditional Ron Paul, golly gosh darn, if it's not gold, it's not real, right? And what sold me on it was watching some empirical examples, and I get that over time governments get better at doing what government things, right? And so these examples may not hold up, but it was seeing the way that people reacted in Venezuela. India had a currency crisis. There was limited the way that cash was used. It was a whole thing. And increasing the examples of China, where you actually saw people within times of hyperinflation, things like that, actually move to Bitcoin and use it effectively. And again, I think the fact that China to this day has not been able to truly destroy Bitcoin use is something that is worth considering. And I also think that this is a side narrative, but I know that there are some on the right that kind of have this idea that China's economy is triumphant, and like China is a and sometimes you get a lot of libertarians falling this trap. Like, oh well, China's buying up a bunch of gold, and really what's going to end up happening is that the dollar is going to fall and die because you're going to have China and Russia come together and create a gold-based currency, and it's going to completely wipe out the last remaining power that the American empire has. Well, the bad news is that I wish that was, in many ways, I kind of wish that was the case. I wish the dollar was going to kind of be the last little Jenga piece here. Unfortunately, I think you're actually going to see the dollar continue to strengthen relative to everyone else, because everyone else is bad. And like when people get, when Zimbabwe starts printing up $1 trillion, bills, they use dollars instead, right? So I think the dollar is actually in the short term going to benefit from all this sort of stuff. But if China really thought it could challenge the dollar, like if they were concerned more about the geopolitics of money than their own domestic control over their economy, they wouldn't have, as they did last year or maybe a year and a half ago, utterly destroyed their Bitcoin mining capabilities. I mean, they confiscated miners, they ran them over with bulldozers. They completely undermined what could have been, in theory, a massive geopolitical advantage that they had. Because if you actually look at the holdings, and the Chinese government, from confiscation and all those things that the Chinese government does, actually held more Bitcoin than the U.S. government did. I think the Ross Ulbricht, thing was one of the biggest benefits. The U.S. government, Uncle Sam, got a whole lot of Bitcoin from locking up Ross Ulbricht and throwing him in jail for like 3 life sentences. And whereas, like, if you look at Chinese gold holdings, right? China's bought a lot of gold, but their gold holdings relative to the U.S., assuming we still have it, that's a whole other thing. But let's assume that America has the gold that's unreported. I don't think we've had massive shipments elsewhere, right? Just for the logistics reasons. China actually had significantly more Bitcoin than the U.S. government did. So if the government wanted to do it, but the reason why China doesn't, right, is because they're terrified of Chinese people being able to escape the Chinese banking system, which, again, American politicians going on about China artificially lowering its currency to kind of be competitive on the global trade market. No, I mean, China artificially pegs up its the yuan. Again, their economy's even crazier than ours. So it's because Bitcoin is scared of the little they can do with direct Bitcoin transactions. The issue, of course, is if you want to take that Bitcoin and turn it into yuan, right? There's limitations to that, and obviously you have to do exchanges within yuan. So all that to be said, practical solutions on making Bitcoin and honestly gold and silver more viable here. I've got, for your audience, one simple, big idea. This is something that I think politically could be done as early as 2025. And the idea is this: simply eliminate, and some people might roll your eyes, this is a tax cut, but it's okay. It's a good tax cut. It's a very specific tax cut. My tax cut is eliminate taxes on gold, silver, and cryptocurrencies. Eliminate the capital gains tax so that if you exchange your Bitcoin for dollars, you don't have to pay any tax on the valuation thereof. Well, that sounds small. There's a lot of really big ramifications to this. One is that it simply helps open up, it helps free exchanges to be made with gold, silver, Bitcoin, Ethereum, whatever your coin is, right? It opens up a marketplace of different currencies that people on the margins, this is not going to be normal, right? This is I'm not going to suggest it's going to open up and, your coffee shop down the street is immediately going to do this, but it opens up the ability for people to do transactions outside of a dollar system that has become the number one weapon and tool of the regime, right? Again, the number one foreign policy tool of the regime is sanctioning Russia and cutting off their access to bank accounts, right? Cutting them off for SWIFT. Domestically, debanking is the number one tool they use against political dissidents, right? So if you want to try to help create an opportunity to allow normal people to do transactions outside of the number one weapon of the regime, this helps provide some space. This would also be a major slice to a lot of the attempts to regulate crypto in ways that undermines its capabilities. Today there's a woman named Caitlin Long that has been trying to charter a Bitcoin bank within Wyoming. She's a total badass, someone highly recommend looking into. But she was talking about today during a panel that she's been trying for like 2.5 years to get chartered by the Fed. Today, the New York Mellon Bank, one of the largest banks, recently just got, it's a holding bank, got approved by the Fed to hold cryptocurrency, right? They're preventing her from chartering her bank because crypto is risky, and yet they're allowing a systemically important institution to now hold Bitcoin, right? This is pure cronyism, nothing surprising. This is the history of the Fed, but just to kind of identify, this is the stuff going out there. If you want to rein in the ability for the SEC, for the Fed, so if you are a Republican legislator and you are trying to rein in what the regulatory state can do to this product, here is something that legislatively can be controlled to help undermine the administrative state's attempts to rein in Bitcoin. Best of all, this also has some great boomer appeal because there's been a lot of banks like Texas has a state gold bank, right? You've had various banks that have eliminated their own sales tax and various taxes on gold and silver, right? And so you can kind of play out the sort of constitutional 10th Amendment appeal, like, oh, well, if we have states wanting to do this, well, then, let's get the Fed out of it, right? So again, for those folks, that has that appeal in there too. The beauty of this, though, is that because it's a tax bill, you don't need 60 votes. All you need is 51, right? And best of all, you don't need to make this a standalone bill so it gets all sorts of scrutiny, right? You simply staple it to whatever the next generic, boring tax bill Republicans propose. 2018, Marco Rubio. They needed every single Republican vote to pass the Paul Ryan tax bill, right? Marco Rubio said, I'm not going to vote for this bill unless we double the child income tax credit, right? Good policy. One of the few times I'm happy with Rubio. But he used his leverage to get something he wanted. Rand Paul, nothing, right? I was very disappointed with Rand. Rand could have held his line right then and been a god for the crypto world, and his PAC would have been overflowing with industry money, right? Because he did them a solid and immediately made them more valuable. He failed. Many such cases. If you have now, let's say you have a 53-47 Senate, right? Guess what? Rand gets another time to prove himself. All you need is, let's say 4, 5 senators that get together and say, we are not going to pass generic Republican tax bill without this, right? And what you do is that not only is a tax bill that fits, that satisfies my wonkish little policy niche, something that I think has massive consequences, but not only that, it's a tax bill. One of the things I loved about Sam Francis and kind of the recognition of the importance of patronage, right? The war must fund the war. If you pass this bill, the net worth of every holder of gold, every holder of Bitcoin, every holder of silver, right? People concerned about the Fed money going up, right? They're immediately made richer. It creates a new savings device that normal people can invest in without needing to hire a financial manager, right? It's something that would immediately financially benefit people who are disproportionately on our side, right? Think of Peter Thiel. Think of Blake Masters and how much Bitcoin Blake Masters has. Think of what would happen if Peter Thiel is even wealthier, right? If Blake Masters makes even more money, right? That's the dynamic of this. That also, I think, makes this specific sort of very small, very subtle. It's one big idea. It's a small idea that's one big thing. It's gonna be done with 5 senators, and already we got Rand Paul, we got Cynthia Lummis, who is a surprisingly good, I think Lummis maybe, who's a surprisingly good Bitcoin radical from Wyoming. We have Blake Masters on the ballot, who would be the perfect spokesperson for this. We have J.D. Vance, who I don't know what his opinion on Bitcoin is, but I do know who his biggest benefactor is, right? Mm-hmm. We have Mike Lee, who actually helped me stop a really bad Federal Reserve nominee in the Trump administration, a guy named Marvin Goodfriend. That's a whole other story in itself, but he's talked good stuff about gold, right? So that works there. Ted Cruz likes to pretend he's on Bitcoin. I don't trust Ted Cruz at all, but I trust him more as a 6th vote than that necessary 3rd vote, right? So there's a small contingent of people already that after this election cycle, some of them think strategically enough to understand the significance of this that could already be in place by the time you have a Republican president, Senate, and House. And so that is one small way of creating the space necessary to help benefit this sort of larger challenge again, that the people that recognize what time it is and recognize the need for dealing with the real power structures that matter. And if you have that happen here, the consequences that have elsewhere, there's a reason why you see El Salvador, you see African nations, you see countries that are not that are kind of slowly sort of budding up, not willing to kind of be vassal states of the GAE. They are increasingly interested in Bitcoin. So that is something where, again, it's not a solution for the dollar, and ultimately, given how much the dollar is dependent upon, ideally, what the best thing that could possibly happen to us would be for something that preserves the dollar and kind of gets us back to that gold standard. But that requires, again, having that requires reform. That requires having people in place, central bankers in place that we can trust. And that's not going to happen anytime soon, right? I don't think it's impossible, but it's not going to happen anytime soon. And we shouldn't delude ourselves into thinking that we can intellectually change the Fed until they're forced to change. But this could create something on the margins that could help provide safety rafts from the consequences that we're already facing and are only going to get worse, and help benefit precisely those people who are the most concerned, I think, about the things that we share.
No, I mean, it sounds like a promising avenue. It just, it runs into the same problem that everything does. And not to be a naysayer, because I hear this for every solution I offer to, is basically you're asking power to vote to reduce its power. And you also are always going to have kind of this argument, which is only going to increase. Of course, they're going to use this to go after everything. But, this is going to benefit people who want to buy black tar heroin and traffic 12-year-olds, right? That's always going to be the argument against moving to these less government controlled currencies. Is the exact thing that you like about them is the very thing that criminals obviously do like about them. But but that's always going to be the bat that they use to kind of hit this stuff with, right?
Right. And that's why I think one of the strengths is that because it takes a lot to explain, mm-hmm. right? There's the nuance matters. In this case, I would argue that you're actually strengthening the power of Republicans, right? Because the Fed, because there's that grow in that financial class that benefits those that could benefit from it. It's also a dynamic where if inflation, what you really need for something like this to work, ideally, is for the price of Bitcoin and gold to rise, right? Because then you can sell it as an inflation solution for savings. Ultimately, I think that's the best way of because this is one of the issues that we have, is that inflation is the number one political issue in this country. Right, it is the ultimate kitchen table issue. It's something that it's a tax that we pay every time we go to the grocery store, the gas station, et cetera, et cetera, et cetera. And yet no one has a solution for it. No one even tries to have a solution for it, right? And so if you can create a dynamic where, and you could have sold this back when Bitcoin, when number goes up, right? It's harder to sell when number goes down. That's where I think, in I think a few years, this dynamic's going to get interesting, because something to look for, and again, is this international component? Because if there's one thing I can emphasize, again, as bad as everything I've outlined with the Fed is, Europe is so much worse. I mean, Europe is a cancerous tumor on this world in a variety of ways, right? The state of their banking system, the exposure that they have to China, the exposure that they have to Russian debt, which I still don't think they've really dealt with, right? Because you've had, again, negative interest rates, which means that, again, they've had the European balance sheets, again, the biggest issue that you've had in England right now, right? There's massive crises because of the pension issue, because, again, they're not able to pay out the pensions because of the screwing around with conservative investments. And so when you have European banking institutions go under, when you have there's going to be other small central banks. I mean, people around the world are feeling this problem. You're going to start having people, I think, pivot to non-central bank alternatives. Now, again, there is the other alternative to this, right? So let's assume that fixing the gold in the short term isn't a solution. There are things to be done for those that are interested in this topic. James Rickards has some really interesting books on this. He's not an Austrian. I'm not endorsing everything he says, but he has a lot of really good practical stuff on like repegging the dollar. And again, if you have some grownups in the room, I think this is possible. And again, it doesn't ultimately solve the larger issues, but I think you can get something much better than what we have right now. And, at this point, I'm happy with less bad, systems.
I'll take your wins where you can get them, right?
I'll take them. But let's assume the dollar's not fixed, which would take a lot of work. The alternative solution, when you start having European, like the ECB or smaller banks fail, that's where the IMF is going to step in. The IMF already has a product called special drawing rights, SDRs. And they've used this in the past to bail out certain firms when they didn't take dollars. And so what they're going to try to do is, again, increase the role of this explicitly globalist IMF currency as you have central banks failing. Back in 2008, the Federal Reserve was the massive bailer out of the world. The Fed is not in a position to do that this time. The IMF is going to bail out these institutions. And so that's where it's going to be interesting. And I think you're going to have some small countries that end up going along with the IMF line, right? The closer you are to the GIE, the more managerial controlled you are, right? The more your power structure is defined by neoliberalism, you're going to go right along with the IMF. But for those other countries that are skeptical of it, that is where you're going to have gold, Bitcoin, these other alternatives pop up. And some of that, they may take dollars as well, but like you're going to have more opportunity there. And when you have an increased global demand on some of these alternative currencies, I think that's where you're going to start seeing Bitcoin go back up again. I think that's where you're going to see gold go up again. Maybe one goes up more than the other. Maybe Bitcoin tanks and gold takes over. I'm not predicting any winners there necessarily, but I think you're going to have some of these alternative currencies go up. And I think that creates a dynamic going back to that reform, is that if you're able to save in non-dollar assets and benefit, that I think politically it really helps the opportunity to kind of interject the idea of alternative money systems in a political way that actually creates some weight. Because again, it wasn't all that long ago where political posters literally were carrying politicians on a coin of gold, right, and making monetary policy an inherent part of the system, right? I get that the political demographic is not quite the same as it is back then. People were a little bit more well-read, but again, given how important inflation is and the consequences of it, I think that if we start engaging that issue, and if we have certain figures that can communicate of it, that's why I am all in. I'm an unabashed slappy for Blake Masters' run, because I think he is someone who uniquely, I think, understands these issues in a way that Rand Paul should have. If you have a little bit of leadership and a little bit of way of really articulating this in a way. Again, this is still, I get it. It sounds a little bit naive and liberal because you're assuming that the political system can operate in sort of, in a way that actually creates a solution. And I get that. But it's all you need is 5. You need 5, you need leverage, and you need self-interest involved. And that's where I think makes this this is my one card I have out there. It's the only solution I've been able to figure out on how to make a sizable difference in the short term.
It's all right there. I will let you bring some white pills onto the stream. Normally this is there's a solutions free zone, but I will allow you to hand out that hope here. I appreciate you bringing it in. All right. So let's take a look at our super chats here real quick as we're wrapping up. Let's see. We have HD87 guy, just a donation for $5. Thank you so much, man. I appreciate that. Let's see, guys. We got a few backed up here. Want to make sure I'm getting all of them here. All right, so Judge Lot for $20. Thank you very much. Though I used to call myself a libertarian, when I listened and read Reason and quickly stopped. They are far left culturally. Do you find them as cringe as I do? By the way, I met you last year in October in Tampa, and we have a great conversation. So, Tho, what do we do about culturally left wing libertarians? What do we do here?
Yeah, I mean, I find myself, I don't like the libertarian label.
Yeah,
It's I understand like the cultural argument. Like if you talk to Nick Gillespie, his defense of libertarianism as an ideological project is it's the freedom to engage in alternative lifestyles. And I find that something that is a project, and I have no interest in. The way that Mises defined liberalism was simply property, and of course, I think that's where any classical liberal trying to defend the current status quo without recognizing that as soon as we transfer to a civil rights environment and rather than a property rights environment, the entire liberal project was gone, right? And so I understand libertarians that say oppose Ron DeSantis banning vaccine mandates on private businesses, right? All of the private rights arguments against big tech censorship, etc. To me, I have no interest in them because of a lot of the stuff we were talking about today. These are not, large corporations are not private institutions whose political power comes from the merit of the market.
yeah.
They are state subsidized enterprises who often work explicitly at the behest of the state. And if you are a libertarian that has, and libertarians have no solution to this, DeSantis does. And so, if I don't care if it's a national conservative or whatever, Ron DeSantis, again, being a Floridian, as someone who has spent a very long time as a Rothbardian libertarian, I had my own, political crisis because I didn't know how to reconcile being a Rothbardian and being proud of my governor. But it's precisely where I found myself in 2020. And so, this is where, I kind of consider myself a Jacksonian libertarian, right? I still have that sort of folk, the term folk libertarianism is kind of thrown around there, usually derisively, about like the Alex Jones, kind of skepticism of the state. And I'm fully in favor of that. But when libertarianism becomes niceness, it comes to this abstract notion of tolerance, throw it away. And again, I have no interest in being a part of a movement with reason, with tragedy, that Ron Paul brought so much money and energy into organizations funded by the Koch brothers who always hated Ron Paul and the movement and the people around Ron Paul. And it's a shame that they benefited from this. And so again, I'm fine. I have no interest in a libertarian movement or a liberty movement. It's a whole bunch of people just trying to grift off of this pet ideological cause. And I'm very proud that the Mises Institute has always been above that. We've always been a place for Christians. We've always had a very strong cultural conservative bent to it. And we actually just had Paul Gottfried at our 40th anniversary event, which was a wonderful time. And so I'm far more comfortable at a NatCon event than I will be at any libertarian movement event in the near future. And that's the area where I'm interested in reaching out. Those are far more my friends than than any regime libertarian out there.
Yeah, I think that's really healthy, and I think it would be a good message. Like, I understand the attachment to the term. You're like, we had it first, you guys destroyed it, but at this point, if you have Bill Maher and Greg Gutfeld and like Ron Paul all calling themselves libertarians, you know what I mean? Like, it just doesn't mean anything at this point. That the term is ruined, and of course, labels are always messy and it's always difficult, but we always need them. So there's no escaping them, no matter how much anyone wants to. But I think there's a lot of good stuff that is otherwise blackened by the label of libertarianism. And I think it's understandable. A lot of people are running away from it to just kind of save what's worth saving there. All right, Colin here for $5 says, "How can I start a bank and become part of the Fed?" All right, get your bank starter kit. Where do we get one of those?
Yeah, be born into the right family.
Yeah,
goes a long way.
It's not a lemonade stand. I can't.
Yeah. No. Well, again, if you want a practical example, what Caitlin Long's been doing is a very interesting project, and again, it's a great demonstration of the way this entire system is rigged against small people. There have been some nerdy sort of wonkish arguments for expanding the amount of people that have access to kind of the special privilege the Fed has. But I don't think it's going to go anywhere because, again, like, that requires people actually interested in sort of boring reform, and there's no one that knows enough about this stuff that's not bought and paid for by the Fed. So, try to operate if you can get some operate enough capital and lend it out to your buddies locally. See what you can get away with, but it's a very broken system as it stands right now.
All right, we got Sean Weiland here for $5. Thank you very much, sir. Public traded companies via managerial revolution are loyal to the regime since they get stock buybacks via cheap credit rather than profits.
Yeah. No, again, the distortion that, again, and this is like my one critique of, my critique of Burnham is that I think some of his stuff, obviously, it's very prescient right now. I think Burnham makes a mistake where he assumes that capitalism is inherently inferior to managerialism, right? There's kind of some of his stuff in there. But I think a lot of I think Curtis Yarvin's made this point too, is that Yarvin kind of scoffs at his analysis of the publicly traded company aspect within the book at the time it was printed. Mm-hmm. But I think if you look at the way that Wall Street operates now, it is very much aligned with that. And then, of course, you have this additional element of the Black Rocks of the world, right, that become massive shareholders. You have this additional aspect where the debt, and I touched on this earlier, where there's global financial regulation, Basel III, that you had that international banks had to have certain quality debt on reserve, and that corporate debt, securitized corporate debt, was able to be used as a certain type of reserve balance asset. So that only further kind of subsidized the moneyness and therefore the cheapness of corporate debt. And so there's so many aspects to which, just again, this entire financial system benefits the very elite, which again makes them most beholden to various power structures out there. And that has essentially led to what my friend Sean here is describing. And it's absolutely insane.
Absolutely. All right. So Colin here for $5 says, controlling the flow and supply of money is a source of power. Will cryptocurrency be allowed to succeed knowing this? And we kind of touched on this a little bit, but if you want to expand.
Yeah. It will never be allowed voluntarily by the Fed. It will never be allowed by the administrative state. They're going to do everything they can to fight it. And, it's going to have to be forced. Now, again, there is this element where, Bitcoin is still being used in very hostile areas. That will limit who can use it, but it's still out there. But I think if you create very concrete lines that limits the way the government can do, I think there are some different. Again, I think the motivations of the Senate are different than the Fed, or at least can be. And so that's where you have a little bit of friction within some of these governing institutions that could perhaps be co-opted in a way of allowing it. But the Fed is not going to ever really allow for a friendly environment if they can stop it. And you've seen, again, increasing escalation over time from Bitcoin being a joke and a laughingstock and a mild curiosity to being something they recognize they have to stop.
Colin in here for $2. He compliments your quality mullet there. Thank you very much, Colin here.
I do speak fast. I apologize for that.
Yeah, no, that's fine. Getting a lot of information in here, quite a bit. We've got another super sticker donation. Thank you very much, sir. Don't know exactly how to pronounce that name. I'm sure I do it incorrectly, but thank you very much for your donation. All right, though, before we get out of here, I'll thank a few people, but why don't you go ahead and tell people where they can find you, and are there any projects you want to direct them to, anything you want them to check out before we leave here?
Yeah, sure. It was a pleasure joining you. I've been a big fan of your work for a while now. You can find me on Twitter at Tho Bishop. It's a weird name, not many others out there. If you're interested in this topic, I wrote, we had animated a video series at the Mises Institute, What Has Government Done to Our Money.com. It's based off of a little book by Murray Rothbard. I go beyond the book. I talk about some of the consequences of politicized money, some of the contemporary stuff. But it's like 9 3 to 5 minute long videos. What has government done to our money.com? And if anyone out there is interested in learning more about Austrian economics, please hit me up either on Twitter. You can email me at tho@mises.org, mises.org. And I'll be happy to send you a copy of How to Think About the Economy, which is a new book we have out by Per Byland. It's a short read. It's not necessarily money related. It's just kind of economic reasoning, kind of the bare bones there. But if anyone out there is interested, please hit me up and I'll send you a free copy.
Excellent. So, thank a few of our Subscribe Star supporters for the channel here. Want to go ahead and thank Easter Worshipper. Want to thank user F1F00C09. Want to go ahead and thank Santa, the big man, of course, always supports the stream, and we are very grateful. Want to thank AWXYZ, and let's see. I think that's everybody for this one. And then it looks like we had a couple more super chats come in here, so let's grab those before we glow. Glow in the dark for $10 here. When companies went from trying to get customer money to investor money or grants, it really shows who controls the money. When the market doesn't serve the people, it becomes toxic and an extension of the state. Yeah, we have conquest laws in effect here, right?
Right. And again, the more money is politicized, the less profit comes from kind of the meritocratic aspect of the market.
Mm-hmm.
The more it's allocated, like that's all gonna, it's all gonna consolidate power, right? And so that's the problem we have right now.
Are you familiar with land and accelerationism? Have you touched into that subject at all?
Not as much as I should be. I do know that he went down sort of the Austrian rabbit hole, but I've not gone deeply into his work yet. But I've had it recommended to me.
Yeah, I would suggest touching on his techno capital stuff and his acceleration stuff, and if you find that interesting, maybe we can dive a little deeper into something I'm more familiar with next time in that area. I think you might find that some fascinating stuff that connects a lot to what you're talking about. All right, and then we have Sebastian De Los Reyes here for $5. Any more books on the topic? You named a number there, but any other suggestions? People some basic understanding on the Fed and some of the monetary policy that you've talked about.
Yeah, one of the best is The Mystery of Banking by Mary Rothbard. Another one is the Origins of the Federal Reserve. If you want to kind of go more in that, a lot of that material is in the Mystery of Banking. That one goes a little bit broader. He also has a great a history of banking in America book. Obviously, I'm biased here. If you want some other stuff, Boom Bustology is a book by a Ivy League economist that actually it's interesting because it has a few different lenses. One of them is Austrian, one of them is Minsky, so you get a few different sort of looks as well. But it does a good job of identifying a lot of the booms and busts consequences of the Federal Reserve there. So that's something a little less kind of shameless promotion. But really on this issue, I really recommend Rothbard's stuff. It's really readable. It has a great historical component. Again, he really does kind of the power elite stuff. And again, if you have any other questions on specific topics, I'm happy to make recommendations. You can hit me up, email, Twitter. I love trying to connect people with words, with topics they want. There's also a really fun animated movie that was like 2010. I don't know who made it. It's like it's an interesting cartoon, but I think it's called like The Death of the American Dream. And it has, again, it's a really high production thing, but it goes into a whole like Creature of Jekyll Island sort of narrative. But that's also out there. Again, I have no connection to it at all. It's like 30 minutes long. But if you're interested in this stuff, it does a great job. It's really great for normies if you're interested in going down that rabbit hole as well.
Excellent. Yeah, make sure you check out Tho on Twitter. Like he said there, he's very active, and I'm sure he's very enthusiastic on helping people with education. So if you need any more information on that kind of stuff, I'm sure he will be more than happy to help you out if you contact him there. All right, guys. Well, thank you so much for joining us this evening. Tho's been a great and very informative guest, so really appreciate him coming on this evening. If this is your first time around here, please make sure to subscribe to the channel. I've got all the links below if you want to subscribe also to the Substack. Go over to the Gab. If you ever want to watch this stuff on Rumble or Odyssey, I'm automatically transferring these streams over there as soon as they're done here, so you can go there as well if you want to enjoy them on all tech platforms. But thank you guys so much for joining us, and as always, I'll talk to you next time.